Welcome, ladies and gentlemen, from me, Guy Munson, to our regular 6-minute strategy update. This week, I'm going to look at the US presidential election, 89 days to go, and try to look at some of the implications for financial markets from a UK perspective. First of all, let's look at the polls. I've used the Real Clear Politics average, which is a composite of a number of US polls. The red is the Biden vote, the blue is the Trump vote, the light blue is the difference between the two. And the message is clear. Really, for the past 18 months, the Biden camp have been running a steady advantage over Trump, and this seems to be holding in, though narrowing a little bit in the last few weeks. On slide 3, I've looked at the presidential approval ratings, who disapproves and approves of his policies overall. And this has been Trump's key problem. That approval rate has been stuck in the low 40s. Which is a problem for him going into the election. He seems to have a difficulty, if you like, about reaching out across the aisle. And you can see the difference between the two. That problem has been accentuated if you run that same chart, but this time on slide 4, asks for the presidential job approval on the economy. And there you can see Trump was polling very well back in February. And of course, his handling of the coronavirus, the sharp rise in unemployment, the sharp drop in business activity across the state has hurt him, as it's hurt many politicians. And that lead he had on economic competence really coming down and matching Biden. So that's going to be critical. It's not without opportunity for a turnaround. The business surveys across America are improving. There's no question about it, despite the extension of some of the lockdowns. We had this week the ISM, the biggest and most famous of the surveys, both manufacturing and non-manufacturing, well above 50. That indicates expansion, and both ahead of underlying estimates. But the challenge comes on the right, what people think in terms of consumer confidence. And that is understandably not flowing through yet. And that really feel-good factor or feel-better factor has not come back in any meaningful way because of extended lockdowns and virus uncertainty. One of the questions that a lot of investors ask is, under a Biden administration, would the attitude towards China change, which is, of course, driving so much of the international geopolitical backdrop? Well, I've put up here on slide 6 the latest Pew survey, which asks Americans their opinion of China. And I'm afraid you can see the results quite clearly. Those who are somewhat unfavorable and very unfavorable rising sharply. Those who are very favorable down to China, just down to 3% of those polled. So I'm afraid this is a bipartisan, across-the-aisle issue. So let's take a quick look at Biden policy, as we see from his website and other sources, and see how this might affect the market. Well, first of all, it comes as no surprises, taxes will go up. Corporate taxes will rise from 21 to 28%, it's indicated, not reversing all of Trump's cuts, but a large portion of them. Minimum taxes for domestic and foreign income. And of course, a big ratchet up in taxes for the higher earners and the top 1%, a global phenomenon, I suspect. So this is market negative. It will damage earnings. It is less of a favorable stock market backdrop. But set against that, there's a huge investment pool targeted at the new green economy, this $2 trillion fund, which I think will excite a lot of Wall Street, drive a capex expenditure, particularly areas, say, like clean engine technology and charging infrastructure. Pharma will come in for a rough ride. Expect Medicare to be allowed to directly negotiate for drug prices, but that's always a scare in Democrat administrations. 3-year likely rollback of Trump-era energy deregulation and fracking, oil and gas, but that's a low weighting now in the index and, of course, in our portfolios. Expect the Biden administration to immediately rejoin the Paris Accord, and they've already announced they're going to target a carbon-free power sector by 2035, so more drive for that green spend. A closer engagement with allies, I think that's clear, but I think he will use that pull to try and get some sort of international group together to contain China. Finally, a strong antitrust push, particularly targeting the tech companies, all the more so if Elizabeth Warren has a prominent position in the new administration. I think where markets would worry if there was a clean sweep, I think if there was a real dominance in all the houses and the White House by the Democrats, that would worry investors. And typically the stock market has performed much better with a split president and congressional representatives from different parties rather than from the same. As you can see for the asset performance for this year to date, markets are not worrying yet. Yesterday saw another new high for the Nasdaq. But I think it will become more of a focus, and it is slightly worrying, this aggressive upward trend in gold, and of course bond yields which remain stubbornly low, suggesting that uncertainty and a real belief in economic recovery is still elusive, and that will be the challenge for any administration going forward. Well, I hope those are useful indicators. We'll be factoring them into our thinking, and thank you very much for listening.